Hello, I'm Yutaka Watanabe, a tax accountant. This is the Tax Accountant Nabe Solves Your Money Problems channel. Today, I talk about where to look in asset items in small-scale M&A. When considering the acquisition of a business, how can we truly determine its real value? In this session, we will focus specifically on the balance sheet, particularly the asset section, and go through a practical checklist to help ensure a successful acquisition. Now, imagine that the financial documents of a business you are considering acquiring are right in front of you. The balance sheet, the income statement, numbers everywhere. It can feel overwhelming, and you may not know where to start. That feeling is completely understandable. But don't worry. The answer is actually quite simple. The first place to look is the assets section of the balance sheet. Everything begins here. Let's start with the first section, current assets. These present how financially healthy the business is in the short term. In other words, how powerful its cash generating engine is. This is an extremely important indicator. So, what exactly should you check? There are these key points. First, cash and deposits. Confirm that the stated amounts actually exist by checking objective evidence, such as bank statements or certificate of balance. Ensuring that the book figures match the actual balances is fundamental, yet surprisingly often overlooked. Next, accounts receivable. These are amounts that have not yet been collected from customers. Carefully check for overdue or potentially uncollectible receivables. In some cases, all receivables that have remained unpaid for years may still be recorded as assets, even though their real value is close to zero. This can lead to a significant overestimation of the company's true financial strength. Reviewing collection histories and payment cycles for each customer is essential. Finally, inventory. Check whether there is excessive unsold stock sitting in storage, especially for goods with expiration dates or items sensitive to trends. Inventory that appears as an asset on paper may have little or no resale value in reality. These three areas must be thoroughly examined. Why are these so important? Because the quality of current assets directly determines the company's ability to generate cash. They are essentially the lifeblood of the business cash flow. Now, while current assets reflect short-term cash generating ability, fixed assets represent the long-term value of the business. Their purpose is entirely different. Let's move on to section 2. fixed assets. These form the long-term foundation of the business, the structural backbone. However, caution is required here, as hidden risks and distortion not immediately visible in the books often exist. There are two major warning signs to look for. First, unrealized losses, situation where the book value significantly differs from the actual market value. For example, machinery purchased 10 years ago may still be recorded at a high value on the books, even though it is now outdated and nearly worthless. Similarly, real estate may have declined significantly in value since acquisition. If these losses are overlooked, they can lead to substantial write-downs after the acquisition. Second, the mixing of personal assets into company assets in small and medium-sized business. This is more common than you might expect. Assets such as a company owner's personal car or vacation home may be recorded under the company's name. After acquisition, you may not want to take over such assets, yet their book value is included in the purchase price, effectively forcing you to pay for something unnecessary. Both of these issues can become major pitfalls, leading to a serious misjudgment of the company's true value. Now, let's summarize the key point. The most important thing is to always consider these two perspectives together. Short-term cash-generating ability through current assets and long-term business value through fixed assets. For current assets, evaluate cash, receivables, and inventory to understand short-term liquidity. For fixed assets, identify unrealized losses and any mixing of personal assets to uncover the true underlying value. When viewed this way, the process becomes much clearer. Only by looking through both the short-term and long-term lenses can you fully and accurately understand the overall picture of the business. This is the first step toward a smart acquisition. Finally, ask yourself this question. Is the asset section you are looking at a treasure map leading to future points, or is it a minefield hiding unexpected losses? By using this checklist, you should be able to uncover the truth. Do not be misled by numbers alone. Develop the ability to see what lies beneath them. This is your greatest weapon in making a successful acquisition. Today, I talked about where to look in assets items in small-scale M&A. For more information on small-scale M&A, please visit the website of Yutaka Watanabe, Tax Accountant Office. We will continue to share insights on money, so please subscribe to the Tax Accountant Nabe Solves Your Money Problems channel.